Hi, everyone. To everyone online. Yes, this is financial modeling, and I think this is about the 14th time I've done this, presented this subject. So I did go to West Virginia University. You saw the Pac-Man WVU in my email address. I've been the CFO of a number of Pittsburgh area, mostly small companies. The last was Locomation. If you know who Aurora is and Stack AV, we were in the same space as them. So attempting to design and much harder deploy autonomous trucking solutions. That has not ever actually been done successfully yet, other than on a trial basis. Aurora is hoping to do it by the end of this year. Um, and I am a CPA, but I've been an entrepreneur, an investor, an advisor, and a co-founder a couple of times. So I've helped build companies, and small companies are kind of my thing, if you will. So I started out my career at PwC, one of the big four. I was then with a company that used to be a big name in Pittsburgh, but not really anymore, called Black Box. We were B Box. That was our symbol on NASDAQ. When I left there, we had about 600 employees and about $350 million in revenue way back in 1992. So that's going back quite a ways. I've been with a couple of, actually, probably three or four CMU startups, or at least startups that had CMU leadership. One of those was WiseWire. That was in the mid 90s. I'm going to talk a little bit more about that. CoManage was a telecom software provider back in the early 2000s. Netronome was a chip designer up in Wexford, and we licensed a chip from Intel and actually modified it to then use with our customers, and we were able to generate tens of millions of dollars of revenue out of that acquisition of that chip. Malcovery was a cybersecurity startup that I co-founded in 2012, and then we sold it in 2015. And so that was another really good one. I've worked on LBOs, which leverage buyout. Think of private equity. That's kind of the older name for current day private equity. So private equity is real prominent these days. I worked on an initial public offering, in other words, going public at Black Box. That was quite a undertaking. I've had some exits. We sold that company, WiseWire, remember the CMU startup, to a company called Lycos. Lycos was an early internet search firm. Think of early companies, and this is going to go way back: GeoCities, Alta Vista, Yahoo had search in the beginning, but kind of got out of search pretty early. Precursor to Google. Google wasn't around when Lycos was in its heyday. Lycos also was formed by a CMU grad, Michael Malden. In fact, the CEO and founder of WiseWire was a student of the CEO of Lycos. So the professor ended up acquiring his student's company. I always thought that was crazy. And that was for 40 times revenue. So we sold that company. We were $1 million in trailing 12-month revenue. We sold it for $40 million valuation to Lycos. You would never hear of that today, 40x. Maybe NVIDIA, maybe something like that. But it's really, those were the tech bubble days. We sold our cybersecurity company to a company called FishMe, which was had a CEO co-founder, Rohit Balani. And so that's the second CMU acquirer I've dealt with. And I've raised various amounts of venture capital financing to around $150 million, and done a lot of other things. So anyway, I'm active in the local tech community too. All right, today we're going to talk about financial modeling. Just think of three things. One is building your model and the assumptions that you put into that model, and how you're going to capture that in a tab in that spreadsheet so that the reviewer knows what the heck you were thinking when you created your model. We're going to test the model. We're going to stress test it to make it sure it works as planned. So if you add revenue, or you decrease revenue, or you add bodies, or you add space or furniture, that all affects your cash and your projections. And finally, while it's not core to this presentation, I do give a small segment on funding and the cap table. I kind of simplify the math for a cap table. the cap table is a very nebulous thing, and I think a lot of people get kind of psyched out by it. So I'll try to make it simple. So setting a planning horizon, a time frame to your model. When you start out in Excel, you're kind of looking at the Excel spreadsheet and you're thinking, how am I going to start this? What you need to think about is monthly detail for the first 2 years. So if I assume, I'll make a lot of assumptions here because I don't know any better, but I know of at least 3 startups here in the audience today. There's probably a lot more online. And if you're going to go out to get external funding, they'll want to see the results, both, perhaps challenging in the beginning and then reaching a certain level of success, and then success in later years. They'll want to see that, but they'll want to see the detail for the first 24 months because that's like the most important, block building era of the company. And as you go out, but we all know as you go out, it's going to get less and less accurate and visible, right? So it's going to get more difficult. What are you planning towards? An initial funding round? Again, some of the startups that are involved in this class today may have already taken a little bit of money in from family and friends. You might have just sunk your own sweat equity in. You might, again, have had an initial funding round, or maybe you're going for your, you had your pre-seed round. Maybe now you're thinking about your seed round, something like that. So that'll play into the model. Are you looking to build a company that you can quickly target for acquisition? Hey, I'm going to build this up in 3 years and I'm out of here. I just want to get acquired and move on and get like a success under my belt. Well, that sounds real easy. It ain't, because you end up having a shorter term focus. And while that is certainly possible, that I would caution against that mindset going in. Are you building a company to become public, do an initial public offering? That used to be literally in every business plan I saw. Here we're going to build this, we're going to grow this company, and going to be $50 million in 5 years. And of course, we're going public. Everyone's going public. Well, a very small percentage of companies go public. That could happen. That does happen. That's happened right here from CMU. Think of Duolingo. Think of Aurora having CMU roots. But it's not that common, and it's something you think about once you've had a bit of success under your belt. A SPAC, I actually was involved in speaking with about 40 to 50 SPACs back in 2020 and 21 when they were really hot. A SPAC is a special purpose acquisition company. Basically, what you do is you end up you're the company. We at Low Commission, we were the company, we were the target, if you will. We are looking for a partner to help us to become public. So what we did is we tried to hook up with a company that was already public. All they had on their balance sheet was cash. No product, no service, no employees, cash. And they were out there looking and shopping around, trying to find a target to invest in. And that company would then become the public company. So it's kind of a backdoor way to doing an IPO or a public offering. The SEC really clamped down on it in 2022, and it made it a lot harder for everyone, including Low Commission. We were not successful in our SPAC. We had 3 offers north of $1 billion and had no revenue. So that's how high the valuations were at that point. Or are you building for the long term and see what happens? I would suggest that's the best focused, because what you're doing is you're building the best company that you can. And then if you are able to offer a product or service that customers want, offer a product or service that customers benefit from, offer a customer or offer a product or service that is referenceable by those customers and they pay for, and then you eventually make money on it, and then you eventually become cash flow positive, good things are going to happen at that point. So, take a little bit of a longer term focus and be realistic in your numbers and the time it takes to achieve them. I've seen a lot of business plans. I've actually seen conservative business plans. No revenue in year 1, $10,000 in year 2, $40,000 in year 3. That's probably a lifestyle business. That might be like a cafe. But you also don't necessarily want to show, hey, we don't really know why, but we're going to do $1 million in year one, $10 million in year two, and we'll be 100 million in year three. So it's easy to throw out numbers. What you want to do is to show detail and discipline and thoughtfulness in how you came up with those projections and why you think that is achievable. If you are reasonably realistic in your projections, you'll be viewed as more credible and therefore less risky to potential investors. Of course, you're all excited about your early stage company, right? You should be. You should eat, sleep, and drink it, and you're a passionate founder or co-founder. But investors see that all the time. You need to be able to come off as having a mature, thoughtful, deliberate approach to building your projections. And I just happened to build a model or a template that's been used by a number of people in these prior classes. And it's not perfect, but it's certainly a good starting point. Defining some more assumptions. What you need to do is document the assumptions you make in building your model. Don't rely on the reviewer of the model just happening to know what you meant or what you assumed, and don't have it in a necessarily, a Word document or a notebook that you've got on your own laptop or a computer. Rather, put it right in the model. I've shared hundreds of models, hundreds of versions of models over the last few decades. And the more you put in up front, here's all the assumptions I made. The reviewer then gains confidence in the ensuing pages of the model. And in fact, it's surprising, even with investment bankers on Wall Street, a lot less questions if you have that index, if you will, to your model. And when we look at the model, I'll show you the notes tab that I'm talking about. Again, it tells the audience you actually thought about and understand your own projections. The one thing you don't want to do is get into a presentation with an investor and they say, well, can we pull up the revenue tab of your projections? I kind of want to go through that. And your coworker built it, but you don't really know it when you're presenting it. So you don't want that kind of thing to happen. You want to be crisp, like on Shark Tank. You want them to know the numbers, right? Mr. Wonderful wants you to know the numbers. So think of the same thing. I know that's kind of a funny example, but think of the same thing when you're going to pitch to your own investors. What type of company you're trying to create, that affects your assumptions. Hardware, and I'm going to do this a lot in this class. This wonderful pointer from Logitech, I always talk about this. This is just a wonderful pointer. It's got a laser beam in it, and it's got a laser pointer in it, and it's got a timer, and it's got reminders of how much time I have left, and it's got forwarding for my slides. It weighs about, half of about maybe 8 ounces. It's a perfect little product. So this is going to be my little product example today. So you're going to build a product where you have to actually build something. You have to design it, architect it, quality assurance test it, build it, quality assurance test it again, offer it to customers, and then service it if something happens with it. This is expensive to build. Are you going to start a software company? All you probably need for a software company, in addition to talent, is a laptop and maybe an internet connection, but not a whole lot more. You're going to build a robotics company. Locomation, we were really half robotics and half software. Half robotics, a quarter software, and a quarter AI. That's the best way to describe what we were at Locomation, probably. So that is extremely difficult. You've got a bill of materials called a BOM that you've got to constantly refine and squeeze costs out of, because that was an extremely expensive technology to try to build. Again, it's never been deployed yet in the world successfully. So that is not an easy kind of company to build. Are you going to be an app developer? That's pretty low bar too. Again, you have to have the talent to do it, but in terms of what you need, it's not that hard, the resources. Are you going to be the next AI related company? That's the hot button right now. I don't think I have to tell you the billions of dollars being spent in that arena. It is an absolute free for all spending wise. Or are you going to build start a restaurant? That's every bit as valid of a business too, a coffee shop, consulting business. That's absolutely fine too. But that'll affect, the complexity of your model. Are you going to be a product or service company? We've kind of gone over that. What type of company do you think typically is more profitable over time? A product company or a service company? Product. Why do you think that?
For the product companies, uh, margin cost is very low as you provide product like the same product to every consumers or client. But for the supplies, usually you will have labor costs, like other kind of costs each time.
Right. Yeah, she's right. I believe it's a product company as well, because with a service company, you can kind of think about it. Let's just think about it as an employee. I work an hour for an hour's compensation. I probably can't charge 100 times worth my hourly cost. Maybe Elon Musk can, but the typical person can't charge multiples and multiples of their personnel cost. They might be able to charge 100%, 150%, 200%, maybe 3 times your personnel and overhead costs, but it's not that's a long road. You got to work an hour for an hour's pay, basically. A product company is a lot more expensive up front. Again, I told you what it takes to, I said very, very briefly, what it takes to set up a product. Then you got to manufacture it. And you have to have someplace to manufacture it at. Are you going to manufacture it yourself? In fact, I'm getting to the next one. You're going to build it or you're going to buy it? Am I going to purchase this wonderful pointer from Logitech and then mark it up and resell it? I can't, again, charge 10 times what I paid probably. I can charge maybe 50, 75, 100% more, but I probably can't charge a lot more. But if I build it, much like you said, you enjoy the benefits of volume over time. Those costs are spread over the individual units over time. And with a product, you can also kind of make money while you sleep. It's selling 24 hours a day. You have to work 24 hours a day to earn money as a consultant or service company. So I'd suggest, yes, product company is more profitable in the end, despite its upfront much larger cost. So that's going to affect your model. Revenues, do you want to start out in your early stage company through your own personnel, your own employees, your own direct sales team, which by the way is going to include you as the founder, or partners? So do you think I should partner with IBM to help me rep and get word out about my product, or should me and my 2 or 3 co-founders kind of go out and sell it ourselves at first? I would suggest that you should do it yourself first. And why is that? Because you're going to learn why customers say yes. That's great. I think everyone loves a yes, right? But you're also going to learn why they say no. And you need to know why they say no. Because IBM is not going to, that's an old example, I realize, but I'm using them as an example. We'll go Microsoft, a little bit more current. Microsoft, their sales team is not going to pick up another product and rep it unless it sells and they've got a playbook to sell it. So they're not going to go out and, help you figure out as a little startup in Pittsburgh, Pennsylvania, how to sell your product. But you are going to learn by talking with customers, being in front of them, talking about the benefits of your product or service, and you get the yes and the no's, and you get the maybes. The maybes end up becoming your product management insight. You'll find out, here are the 3 things that if you can do it, if you can deliver it, we'll absolutely buy that. So they'll actually give you your product development roadmap to a degree. So direct sales, and that's going to include you. What type and how many employees do you need to build your company and your product or service? It's funny. It should be the answer of as few as you can get by with. But there are certain periods of time, like the tech bubble days I went through in the mid 90s to early 2000s, or what AI is going through right now and robotics is going through right now. And that is just get there first and spend as much money as you can. SoftBank's throwing around hundreds of billions of dollars like it's burning a hole in their pocket because they want whoever they're going to partner with to crush it. And that doesn't mean going slow. That means going as fast as humanly and technologically possible. But in the very early stages, I don't think you're going to be hiring 20 people in your first month of operation, right? It's probably going to be you and 2 or 3 coworkers, and you're going to work your rear end off. Everything affects your cash needs. We're going to go over this in the model. This is actually a little snapshot of the notes tab, but I'm going to save it for the model. Some more assumptions. What tools do these employees need to do their job? So I get a little bit silly here, I guess. I've been the CFO for a lot of companies for a lot of years, and it is amazing what employees ask for and want and think they need. You as a founder who are probably pouring your heart and soul and probably your certainly your time and probably your money into your startup, you don't have the fanciest setup, do you? Probably not. You might, but the vast majority don't. So as you start growing and take on some early investment, you've got some money in the bank, everyone's kind of happy. The team, the team meetings are a lot happier when you've got water in the ocean, right? Where your company's ship can sail on the waters with a lot of cash below you to buoy the boat. So employees start to get pretty creative in what they want. I want the latest, laptop with incredibly fast microprocessor and memory and RAM and everything. And I need a 48-inch monitor. I know it's the size of a TV, but that's what I really need. And to be honest, to be able to really work on more things at once, I need 2 48-inch monitors, and hopefully, the most high def screen you can think of. They're curved, by the way. I want them curved. And I want a standing desk, which that actually isn't a bad request because, I want to be able to get up and down, but I don't want to have to crank it. I need a push button. And, I think I need a really nice $1,500 Aeron brand chair because, I want to be able to be comfortable in my seat. But to be honest, I've heard that treadmill desks are pretty cool. So I think I want to be able to walk in a treadmill while I'm, coding here. And I want to have a fan over here and lots of plugins for my technical equipment. And so I think that's kind of what I need. That's just a $4,200 setup per employee. So you're going to learn to say the word no a lot. And employees aren't shy. You need employees, but employees are expensive. Where are you going to put them, and how long are you going to stay? I would suggest be as nimble as you possibly can. At Malcovery, we used our dining room tables or our home offices, and we used Panera's meeting rooms a lot. Panera meeting rooms are fantastic, by the way. There's one down here on Boulevard of the Allies. As long as you order any kind of food, it used to be you could reserve them for 4 hours at a time. That ain't too bad. Now, maybe they've cut down on that because maybe it's been overwhelming, but there's a lot of places you can go and sit in a lobby of a mall. They've got a lot of seating there, and you can actually be there 8 hours if you want and monopolize a table. So there's a lot of places you could work for free, and you can be on your hotspot internet connection. I will tell you, in my experience, it is great to have the early stage team together. So remote is great, and believe me, I've worked remote. I can't even tell you the thousands and thousands and thousands of hours I've worked remote in my career. But it is really great for team building and idea sharing and impromptu, I guess I'll say idea sharing if everyone's together, and hopefully real cramped and crowded, because that's when the magic really happens. If everyone's in their office and everyone's got a door they can close and they kind of put their headphones on and everything, you might as well be remote. So if I would suggest kind of being in close quarters, cheap digs, and build that early team to where they become so dedicated to you that they'll run through that proverbial wall for you. And space is expensive. Does anyone know what happens if I sign a lease? I'm just going to say at PPG Place, I know that's a fancy building. If I sign a lease at PPG Place for 3 years, but it just doesn't work out after a year, and we actually the company goes belly up. And I co-signed that as the founder. I co-signed that lease. I guaranteed the lease is what I'm trying to say. Do I still have a legal obligation to that lease after the company goes belly up? Yes, you do. You may still be on the hook for that lease, possibly tens and tens of thousands of dollars, because you were so excited to sign it to get your folks into an expensive space that ended up being too expensive and help lead you down the road of dissolution. So be careful on your space. There's a lot of free and cheap space out there. What physical environment are you going to create? Again, I would go more Spartan and stark as opposed to Google, where you get free catered lunch every day. Maybe you'll get there. Data and telecom infrastructure. What would you need? Well, you shouldn't need a whole lot. We've got these things called phones, and that's pretty much it. When we started our cybersecurity company, it was BYOC, bring your own computer and bring your own communications device. And that was it. That's how you started the company. We didn't really need much of an infrastructure. If you're going to store information, and especially customer information, and especially proprietary customer information, that's a whole different ballgame. So your data needs can become real expensive real quick, either housed on site on your own equipment, which is, there's some risk to that, but certainly security is better, assuming you have good firewalls, that is. Or is it going to be, at AWS online, or is it going to be at a data center somewhere? All of it's expensive. And you may reach the need where you just have to put that in your model. What kind of marketing efforts would you need to gain mind share in your industry or segment or market? A lot. It's very noisy out there. Seen a lot of business models where it's like, we're going to get, we're going to get 3 influencers in the next year to talk about our product and really tout us and spread the word. Oh yeah? Who are they? Have they indicated they'll do that? Do you think they want something for that? They probably do. They might want some stock. They might want some money. They might want some money and stock. They might want some money, stock, and even a board on your advisory board, seat on your advisory board or something. So it's not just that easy to say, here's what we're going to do. If you've got people lined up that you've talked to that have a decent probability of doing it, that's one thing. But just say, we're going to get 3 influencers this next year. That's not that easy. There's a lot of noise on the internet. It used to be easier to gain notoriety and extend your brand and reach online. It is more difficult than ever. And what do we have? About a 7-second attention span now, that of a gnat. So you could spend a lot of money, and it could basically, it's not exactly a Super Bowl ad. So it could go down the drain and get expensive pretty quick. How much will the sales team travel? Not near like it used to. Now, if someone's, again, going to develop a new product, this wonderful pointer, I might want to go to CES in Las Vegas next February, March, and tout this and blow my annual marketing budget, and I'm going to bank on that. That is probably one of the most productive and promising shows with a lot of capability to it. But we're going to go to an industry event, couple times a month, all the time. Man, you can blow some huge money. Again, as the CFO, you can tell I'm a little bit more conservative. As the CFO, I've seen every request for spending money that you can possibly dream of. So the sales team should not have to travel, especially in this day and age. I think we've got a thing called Zoom now. All these assumptions are big ticket items. Big ticket items are going to affect your ongoing cash needs. And you're going to say, well, that treadmill desk sounds really interesting, but the answer is no, or at least not yet. Speaking of cash, everyone says cash is king. That's easy to say. I say cash is King Kong as I hit the desk. So out of cash, out of life, unless everyone will agree to work for free. Keep your model easy to update and understand because you'll certainly be doing it many, 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 many times. So you want to be able to go in at midnight some night and be able to update a few of the variables and not have to spend, 5 hours on this next version of the model to get it to where you can present it to a VC the next day. Based on your assumptions, and we're going to finally look at the model now, you should know what happens if you modify revenues, both up or down. What happens if we achieve 20% higher revenues in the first year than we plan on? Well, hey, first year or two, that's great. What happens if we only hit 50%? As long as you've got your cost of the product or service adequately set up in your model, you'll know what your profitability is with those gyrating revenues up or down. What happens if you add a body? Bodies are expensive. What happens if you offer more benefits? It's great to have pet insurance, but I think I'd like employee health insurance first. So you always want to attract the absolute best and be competitive, but everything has a cost. What happens if you purchase more of those 48-inch curved, monitors? What happens if you need to expand inventory to where I need, 60 days worth of these pointers in inventory because I'm selling them so fast? That can cause a cash crunch. What happens if I'm going to open a new location? I want an office in San Fran and Austin because they're just the place to be. I've seen a lot of relatively early stage companies, maybe year 2 or 3, we're going to set up an office in San Francisco. Year 4, it's like, we're going to close our office in San Francisco after blowing 150K and I've got my tail between my legs, and the board was right. We really shouldn't open up a San Francisco office because someone could have traveled there, once a month and we would have been every bit as effective. No one ever even came to our San Francisco office. So it really wasn't worth it. What happens if you make any change to revenue or cost? You need to know what happens. Okay, now we're going to look at the model. We're a half hour in. And sorry. So we're going to look at the model. And I pulled up the wrong one, sorry. So I don't know if any of you have downloaded this. You certainly can. I'm going to make this a little bit bigger. Unfortunately, it's covered up. There we go. Sorry. Yeah. So if you open up my model, or why don't you just look at the model while I'm going over it? This is page 1. And there we go. Okay. So 3 things I'd point out. Please read this. People don't read this. This model is a template and contains hypothetical data to illustrate how all formulas and integrations flow. You will need to insert or change your own data. A few people over the years have sent me this model with some of their information in it. But I know every cell of this model, so I kind of go through it pretty quick. And a disturbing amount of time I've seen where some of my information is in there. That's not good. What you want to do is make sure all my information is out and your information is in. If they see a mention of my name or a note that has my name, or you haven't changed some of the revenue model cells, they might be calling up Phil Compton and asking them, did you help this company? So yeah, you want to put your own information in. The next one I would point out is variable input, and you can't see this too well, but variable input cells are usually in blue font with a green background. That green is really light there, sorry. I don't do that maybe everywhere in the model, but I try to make an input cell green with blue text so that you know where the inputs are. Kind of helps you a little bit. And finally, funding or cash flow. No funding is inserted into the model so that it allows you to see the raw cash balance. Thus, it helps you determine how much funding you need. So when we look in the model, and we're just going to go to that real quick, because I'm mentioning it. I'm going to go down here to the bottom of what's called the cash flow section. And this row right here, row 151, I'm going to make that a little bit bigger again. Well, I'll leave it like it is. And cash on hand at the end of any period. So cash on hand at the end of, let's say, and I know this is a little bit dated. This is 2020, but you can change the year. So June of 2000, let's just say it's 25. June of 2025, our cash balance is projected to be a negative 250K. So if I'm projecting that, I better be asking for at least that much money, right? Actually, for the first year, if I'm $900,000 cash need, and you know, if this is anywhere believable to me or the investors, I better be asking for at least probably $1.2 million, $1.5 million, because no sooner will you close your first round of financing, you kind of got to start on your next round of financing, and you don't want to be there. Fundraising stinks. Fundraising is hard. I've fundraised 150 times. I've done a lot of it. None of them are easy. Some of them are a little bit easy, but most of them are hard. You would think the smaller rounds are easier, not necessarily. I've done a $40 million round, 39.6 to be exact, in the year 2000. That's a long time ago. That was Pittsburgh's largest VC round in history at that date. It was led by a little firm called Goldman Sachs, you might have heard of. And that round, we actually had people, they were emailing me and calling me saying, you know, I don't need to see your business plan, but what I do need are your wiring instructions. Because I need to send you guys money. I want in. I'm like, oh my God, we're really in the tech bubble. I mean, they didn't even want to sign. They didn't even need to sign, you know, hey, I understand this is a risky investment. I'm a qualified and accredited investor. What I need to know is, when are you closing the round, and where do I send the money? So that's kind of scary, but that's how it used to be in the tech bubble days. Maybe that is how it is in the AI world again. But my point is, you need to ask for at least as much money as your model is saying you'll need. Otherwise, your investor is going to say, well, you know, didn't you think about that? All right, so let's go to the notes tab. The notes tab. And you know, what's funny is I use a regular keyboard, and I've found I'm a little dyslexic on my Apple keyboard. That's terrible. So notes, for example, revenues and deal profiles. So revenues is pretty much the bread and butter of the model. Revenue tab, the revenues and deal profiles tabs contain a pretty straightforward revenue model, a named forecast by customer and product in terms of many situations. In terms of, I'm not sure what didn't happen there. Many situations are more complex and require more model buildup. Let's go to revenues. Here's the revenues tab. And what I've done here is, this model has assumed this is a software company. So we're going to offer software, and I've got several space for several generations of a software, Gen 1, Gen 2, Gen 3. And that revenue is going to be recognized on a SaaS basis. So we're going to basically take this sale of $40,000 and divide by, you know, however many months that equates to in the contract. We're also going to have an implementation fee of $10,000 per customer, just figuring that's how much it's going to take to get in there and maybe modify it, have it integrated into some of their existing systems. Then we're going to have an ongoing consulting where we hold their hand, and they didn't the customer might not have necessarily scoped out the project adequately at first. In fact, customers rarely do. So you'll do a lot of hand holding along the way and charge some level of consulting fees. That's a pretty typical model there. So, and in fact, down lower in the spreadsheet here, you'll see I kind of have a little profile of a sale. It can be my various software products, and these can be different software products. I just assumed there was an initial one, a next one, and then the latest one. This could be software, hardware, and something else. So this is just, you know, my guess as to what your company might have. And this happens to summarize all the information that's above. Let me go to the deals profile tab. The deals profile tab helps me to kind of map out the average deal size and its profitability that I expect to get out of a typical sale. So again, I might have a product or revenue source 1, 2, 3, 4, 5. I didn't know what they were. I ended up making them more relevant to this model, but this could be any old product. And what this top section tries to do is say, we're a software company. Here's the pricing for each of these products. It's going to be individual to your company. Here's an implementation fee. I'm just assuming that's going to be the case for your company and what each of those products will cost. Here's a one-time consulting fee. Again, my assumption. Here's the total profile of a typical sale. And so that's the revenue portion. Here's the cost of goods sold or the cost of service section. How much will the hosting of that software be? I'm just assuming it's online. I had to make a lot of assumptions. I couldn't make a model that had, you know, 7 different dimensions to it. So I kind of just went with one. So if you're going to host a software that customers go out and ping and use all the time, you're going to have to pay for that to be hosted somewhere, right? So these are the assumed hosting fees per product at, let's say, a data center or through AWS. And the cost of those implementation. So it cost me $1,400 to implement product 1. So, and you know, $2,800 for product 2. These are again just assumptions I had. So I end up with a cost profile. Then I end up with gross margins. But the important thing to look at is my gross margin percentage on software. And again, I did this generically. I'm about 70% profitability. A lot of software companies on their software portion of their sale might be 80, 82, 85. It's pretty hard to get 90. I've seen a lot of founders who are like, well, we'll be 98% profitable on software. It never works that way. Maybe on your 500th sale it might, but it's not going to for a while. So 70% is a little bit conservative. On implementation, again, I'm working an hour for an hour's pay. I'm probably not going to have that great a margin. So probably a little bit better than that. But anyway, my blended profitability or margins are in near the 60% range. That's not bad. So this section was just to help you kind of map out how you're going to price and cost your product. Then I kind of went more specific to the deals of this software company, the profile of a typical sale of that software company. I'm trying to learn my pricing strategy up here, and then I'm actually going to product naming down here. When you would get into it, you would certainly get to know that very well. So something I have in my models. Let me ask you something. Does anyone know what a booking is during versus revenue? What gives rise to a booking for a company? When a contract is signed by both parties that adequately identifies the product or service to be delivered or performed, usually by stated timeframes. It doesn't have to be. I mean, customers usually want to know when they're going to get something, but you know, when you're an early stage company with maybe a novel idea, they can be a little bit more patient sometimes. And again, if I didn't say it, that is legally binding and dated. You know, it can't be an undated contract. These are all things that generally accepted accounting principles will look at through a an accounting standards codification, ooh, boy, called ASC 606. At some point, you'll learn about that, and that is you need to be able to report your revenues on a basis that would withstand SEC scrutiny, because you never know what's going to happen with your company. You may be an acquisition target. You may be one of those rare companies that go public. Do it right from the beginning. But at any rate, a booking precedes revenue. A booking occurs when those elements of a contract are put in place. It then might take, and probably will take, a period of time to actually deliver that product or service. In this model, I've actually assumed that bookings, if you look where my cursor is right now, the bookings forecast, all these customers eventually end up being recognized revenue in a section down here where it says revenue forecast. That's when the revenue starts to be recognized. So we look at this cell right here. Here's my note. Revenues start to be recognized 1 quarter or 90 days after the booking months. So I sell software, and based on the customer's need to get ready and our time to kind of get people lined up to do the project, it takes about 90 days on average. That's a pretty good guess, right? I mean, you don't really want it to be a year out. You probably can't start next week, or maybe an early stage company actually can start next week, but it's probably going to take some period of time. So if you remember, up above software Gen 1, we booked it up top on January 1st, 2020 for $40,000. 90 days later, 30, 60, 90, we start recognizing the revenue for that product in April of 2020. And that note, there's a note in that cell that says revenues start to be recognized 1 quarter or 90 days after the booking month. I think that's actually the same note as up top. But again, as part of being credible to your investor audience, you need to be able to map out revenues and the timing thereof. The implementation fee of $10,000, you were able to actually perform all that in that first month, and you recognize and bill on it that first month. The consulting fees probably actually would be spread out a couple of months, but I had it recognized in that same month too. So this first month was a nice month, $33,333. And then you go on to recognize ratably your SaaS revenue over time. Now, when you add the next customer, you add more SaaS revenue. Add the next customer, you add more SaaS revenue, and you're on your way to the beauty of a SaaS revenue model. So I could go into depth on a lot of these things. I don't want to take up too much time. One more thing I want to point out on here is something called the CEO toggle. And you're probably like, what is a CEO toggle? Well, a CEO toggle, which my note's getting cut off here, is basically a what if cell. And what it does, I can't get the cursor to go where I want it, but it basically says, if I modify this cell right here, of the CEO toggle, it will reverberate through the model. So if I want to look and see what bookings were in this first year, what was it? Let's say $280,000 down here. Well, if I only hit 50% of my number, that's pretty easy math, right? 50% of my number is going to be, well, I'm having a heck of a time here. I can't quite get to where I want here. So that cell is going to be, goodness, I'm having a challenge with this here. I apologize. Anyway, I can't get to it. I'm sorry. But if you change that cell up there as 100%, all these cells are tied to that cell. So you can quickly do a what if scenario. If my revenues were going to be 50%, it's going to drop those revenues to, the 50% level. Frustrating. So let's get back to the presentation. Does anyone have questions so far? Again, we could spend a lot of time in this model. The thought here was to go on a higher level, but I kind of wanted to get in the model to show you a little bit of the inner workings of it. Are there any questions so far? Yes.
The following 2 years.
I'm sorry.
Normally, we only forecast the following 2 years.
Well, investors are probably going to want to see on typical 3 to 5. I know that sounds kind of ridiculous. Detail for the first 24 months, month to month basis. And then the next 3 years can be a little bit more of a, simplistic calculation. So, and on the model, I would also suggest to make it a rolling forecast. In other words, if you finished up January, start with February and go till February of the third year. And if February is done, go from March to March of the third year. Always keep it a rolling 24-month forecast. But they'll want to see, I mean, first of all, they're probably going to cut your projections in half anyway. They'll do their own stress testing if you don't. But I think they want to see the detail in the first 24 months to see when you're adding people, when you're bringing them on, when your first contracts are going to be signed, when they're going to be deployed and you actually recognize revenue, and then when are you going to collect that cash? They want to see that granularity for those first 24 months. No one's really going to talk to you too much about, July of your fourth year. You're not going to have your feet held to the fire at that level. Yes.
Would be the major user target deals or CFOs the user of a financial model. Who would be the major user in that early stage?
Who would be the major user of the model? Major user or producer? I'll say investors, but really it should be you. This should be something that you run your company by. Everyone wants to know their budget, right? Think of it that way. I mean, at your kitchen table, that's being talked about a lot right now politically. People sit at their kitchen table and figure out what they can afford and what they can't afford. So this is a little bit similar to that. But the model is every bit as important to you internally and with your management team as it is, to go out and get investment. You want to know what your development team, the tools that they're going to require to build that new pointer, bring this back into play. If you don't know what the costs are or the bill of materials and when those cash outlays are need to occur to keep product development going smoothly, then everything's going to be a fire drill. You kind of have to plan it out. So this should be not only your external planning presentation, this should be your internal planning tool that you live by. And I would suggest you're going to update it every week or two. So it's going to be something you'll need to be real familiar with. I will tell you, a lot of the early stage companies I've been with, the model is outsourced to a finance person, and that's okay, but you need to be pretty well versed at it. I've dealt with a lot of founders that once they start looking at it, their eyes become all cross-eyed and blurry. It's like, oh my God, make sure you're in the meeting because I don't want to have to talk about this. Well, you need to talk about it. You need to understand it. And you need to know why someone is asking for 3 people to be hired June 1st. What for? Why? How's it going to affect product? How's it going to affect our speed to market? How's it going to affect getting our next deal? How's it going to affect cash flow? I mean, ask a lot of questions as to why they're asking for spend. Okay, let's get back to the presentation here. Oh, man. A little bit of a challenge here. There we go. Okay. So there was a tab in there for personnel. It's a lot like the revenue tab. If you add a person in a certain month, it's going to start costing a certain amount of money. So it's pretty self-evident in that tab. So you should have 3 financial statements in your model, and I've already kind of got them here. Your P&L, it's called the income statement, the P&L, your revenues minus the cost, your revenues, which can be product, software, services, or the ever popular other. the cost of goods sold or the cost of goods service, the resulting gross profit of the sale, that's actually pretty good. And that gross margin percentage, that's more like a software profile there, 80%. P&L also consists of operating expenses. Think of that as people, space, insurances, benefits, marketing, sales, all your departmental expenses. The vast majority of which are going to be people costs. People costs typically make up about 70, 72, 75% of your operating costs. It shouldn't be, it probably wouldn't be 90%. I suppose that's possible. Yeah, in fact, that might mean you have a pretty darn lean organization. So the vast majority of your expenses are labor costs. But these other costs like sales and marketing and getting your brand name out there tend to make up a few percentage points as well. And then EBITDA is the result of all product minus all direct costs of that product minus all operational and departmental, mostly people expenses, equals your operating income or earnings before interest, taxes, depreciation, and amortization. That's a mouthful. But you'll want to be versed in what EBITDA means when you talk to an investor. And that's the P&L. Here's the balance sheet. What you own, assets, minus what you owe, liabilities, equals what you keep, shareholders' equity. And the cash flow is extremely important. What you need to be able to know is your cash balance at any given time and when that is going to run out. In fact, let's look at that. Burn rate. Here's 4 terms you should know when you're going out to talk to investors. Burn rate. Burn rate is that when I say the trending amount, I mean like the average for a quarter. In other words, it's not the average for a day. It's not the average for a week. It's not necessarily the average for the past month. It's like, the next 90 days of operations, the next quarter of operations, we expect to spend a certain amount of cash on cost of goods sold. In other words, cost of this pointer again, or the cost of a employee performing consulting services, their personnel costs, plus operating expenses, all those departmental expenses, a lot of which is labor, plus CapEx. CapEx is capital expenditures, and that would include purchases that will have a useful life over 1 year. So that's going to be computers, a lot of softwares, desks, chairs, furniture, servers, things of that nature. It's actually, think of it as hard assets, plus current debt obligations. Most of you aren't going to be taking out a loan to start your company. So while that's in the definition, that's not really relevant to you. Runway. Runway is the amount of cash you currently have on hand right now to cover the burn rate up above, which is likely to increase over time. So if you have $1.2 million in the bank and you're burning on average $100,000 a month for the next 12 months, how many months of cash do you have? 1.2 million divided by 100,000 is 12 months. In other words, 12 divided by 1 is 12. That's pretty easy. What if you're able to keep that burn rate down to 50,000 a month on average? So 1.2 million divided by 50,000 is 24 months. Wow, well, that's great. Or what if I land in the middle at $75,000 on average? Well, you've got 18 months worth of cash then. What you shouldn't be projecting to investors is I'm going to run out of cash in 4 months. I'm fundraising right now, but I'm going to be back in June to get more. Well, no, you haven't sized up your fundraising properly. EBITDA, once again, we went over that. It's the point at which profitability is reached on a sustainable basis. In other words, I'd say for a quarter, 3 months. You might be profitable 1 month, not the next, 1 month, not the next. It's going to be erratic in a lot of cases, but over time, quarterly chunks at a time, when do you cross over to EBITDA break even? Even more important is when will you cross over to net positive net cash flow? Now that may be quite a while for a lot of early stage companies. I mean, when I say quite a while, I mean quite a while. That might take, 12, 18, 24, even 36 months until your operations are truly generating cash. Because you've got to outlay money. I mean, let's just be basic. You got to outlay money to start the company, to hire a few people. That's probably going to cost more than $1. To give them a standard employee setup, not $4,200, but at least, a computer and a chair and a space maybe that they're going to need to work. Then you're going to have to develop the product or service, get it out to market, get customers to use it, maybe even at a beta level, maybe 2 or 3 betas are out there. And eventually they get it, and eventually they pay for it. So it takes a long time from the date at which you first expend or outlay cash to when you finally start collecting cash. And for a long time, you're going to be spending a lot more than you're collecting. And that's going to happen. And eventually, some magical quarter, you're going to be cash flow neutral. That might be, again, 2 or 3 years down the road. And then eventually, you're going to be cash flow positive. The cash you're bringing in, mostly collecting from customers, is going to exceed your company's costs. So that's probably the last metric you'll achieve within these 4 terms, but you need to know these. You'll burn cash before you sell. So I'm going to switch on over to the cap table example, because I think this is one that people find pretty darn interesting. Again, that model, it's kind of big and busy. It can take up a bit of time, if you will. All right, so cap table example. The cap table is not that difficult. I will tell you, it's a scary term, though, isn't it? So what I'm going to do is go in here and take out some information and just build it up in 3 to 4 short minutes and show you, give you some more comfort. Okay, so you're starting a company. Can everyone online see this too? Is this big enough? I'm going to make this bigger. There we go. So you start out the company, you've got founders, and I'm just going to say generically, you've got 2 million shares of common stock. It could also be 2 million membership units in an LLC that you start out the company with. You don't need to have a specific number of shares of stock to start a company. It seems like the average is the board is going to authorize 10 million shares of common stock to be issued over some period of time. The founders are going to be granted some portion of that. And this, in my example, it's just an example, 2 million shares. Now you can actually start a company with 1 share, and everyone gets 0.0001% of 1 share. Does that sound like a lot of shares? You can't wrap your head around owning a 10,000th of a share, can you? But you can wrap your head around owning 500,000 of that 2 million. That feels better, right? It's really emotional, I would say, I would suggest. It's not necessary to have millions of shares, but it's just common. Everyone does it. It's just common practice to have millions of shares. So the founders, let's just say there were 2 of you, get 2 million shares, million shares apiece. You own 100% of the company. You kind of own 1% of nothing. You own 1%. I'm sorry, you own 100% of the potential. That's a nicer way to say it, right? Now you where the model's doing what I ask it to do. Now you bring on your your early management team, and let's just say it was, I don't know, 3 individuals, three rock stars, 3 rock star developers, right? And you end up issuing them a total of 500,000 shares of, again, we'll just go with stock in your company. All of a sudden, the founders own 80%. Well, hey, own 80%, it's pretty much close to 100%. And I gave up 20% for 3 rock stars. Yeah, that's no big deal. I'm in charge. I feel great. And everything's good. Now you bring in a little bit of money, your initial seed round, pre-seed round. I called this a pre-seed round. I mean, I just picked where you were, pre-seed round. And friends and family have given me a small amount of investment, and I've been able to issue them in exchange 100,000 shares. Only cost me about 4% of my company. I still own, me and my co-founder still own 77%. Still feel pretty good about everything, right? Now we're going to add in employees. Employees are expensive in terms of cash, and they are expensive in terms of stock. But they also are extremely necessary in helping your company grow. So we have an employee pool. An employee pool should typically be probably 12 to 15% of all issued shares. Here in my example, it happens to be 13.3%, right around in that range, right? So I've got 100,000 that I've granted to, I'll say, 4 new employees, not the management rock stars, but 4 good employees. On average, they got 25,000 shares apiece. They got 3% of the company. I've authorized, but have yet to grant, ungranted another 300,000. It's my option pool left to attract future employees. Oh gosh, I'm down to 2/3 of the company. That's doesn't equal 100%, does it? But the pie is getting bigger. These people are going to help me make the pie bigger. So 2/3 of a bigger pie still feels pretty good, right? So now I'm going to expand and start looking at an investment. And the cap table over here, if you can see this, I call it your initial external funding round, a seed or a pre-seed round. It's not as complex as it looks. One thing you do know is right now you have 3 million shares outstanding, and that came from right here, right? Got 3 million shares of outstanding of all my activity. I've got 3 million. That's fixed. There's no math to that. It is what it is. But I don't know what my pre-money valuation is. That's negotiated. That's also extrapolated. That's also guessed. That's also fought over. That's also emotional. It's all those things is your pre-money valuation. And there's a lot of different methods in coming up with your pre-money valuation. As you know, again, from my simplistic Shark Tank example, it's whatever a third party will agree to you with on a good faith basis. So we're going to say that we were able to talk with this initial investor or investors, and we got a $2 million pre-money valuation. So now every share is priced at 67 cents. All it is 2 million shares. I'm sorry, $2 million pre-money valuation that I've negotiated with whomever, divided by my fixed number of shares equals the value per share. 2 divided by 3 is 67 cents a share. That's pretty easy so far, right? Now I haven't raised any money. I just have a valuation, and my post-investment round is the same as my pre-investment round. I don't have any money yet, but I know where I'm starting from. So now I have to think about how much money I need to raise versus kind of contrasted to how much am I willing to give up of my company. And again, I go right to Shark Tank because they talk about it every week, right? So in this case, 500,000. Let's just say my model showed 500,000. I know the one I showed you was bigger than that, but let's just go with this example. We've negotiated, there's 2 negotiating things here. 2 negotiating amounts. We've decided that this first round will be 500,000, $500,000. So 500,000 divided by the value per share, just pure math, gives you 750,000 shares for their 500,000. Those additional 750,000 shares now mean my total amount of shares in the company is 3,750,000. And my post-money valuation is pre plus the round equals post the round. 200,000, 2 million plus 500,000 equals 2.5 million. That's really not difficult. There literally were two numbers I had to put in there. That's simple. Investors might kind of make you think, don't worry about the cap table. We'll worry about that. No, no, no. You know the cap table. You be in control. Whoa, 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 whoa. What's that? Whoa. Hey, Phil, yeah, we now own 53.3% of the company. Yes, but you hired your initial team. You've got room to hire more people with and recruit them with stock, and you've brought in money. Yeah, it costs you money. A lot of times your first round is, you'll hear 20% of your company, right? Well, my example is 20.00%. How's that? But what that means is you took a haircut on your ownership of the company. You're still in the majority. And in fact, here's the way to think of it. Us, our management team, our friends and family are really kind of a triumvirate. So we own about 70% of the company. We're always going to think the same way. Maybe that's the way to make myself feel better about it. This still isn't bad, but it's probably only going to ever go down. What could make that go up? Selfishly thinking.
Like buying shares from investors.
You could, that's probably a rare thing to do. It's possible. Be so darn good at what you're doing that you are issued additional shares. The board will say, well, you know what? Founder 1 and 2 have done such an incredible job. We as the board are actually going to grant the founders additional shares. That happens. That happens more than you would think. So it's not something you should bank on. You do have to earn it, but it could happen. And if you truly produce exceptional results, I would encourage you as a founder to negotiate for that. That is probably the only way you're going to increase that. The only other way would be is if someone sold their stock back to the company, it became part of what's called treasury stock. That's kind of weird. But see, this isn't that complicated. Now, what if we have to go out and raise $1 million? This is my last bid on this. $1 million. We had to go out and raise $1 million. Phil's, my model said we needed $1 million. We're going to raise $1 million. And that got him a third of the company now. And I am now below 50% ownership. You may well have to get used to seeing something that you're a little bit uncomfortable with, because the whole goal of all this is you're making a pie that's only theoretically worth something into a bigger pie that will hopefully more practically be something. So this doesn't always hold true. You might be able to get by with less funding. I mean, I think I've been, this is probably this is probably a pretty typical goal of an example for you to reach. That's textbook. The stock option amount is textbook. The ownership percentage around is pretty normalized. Being just a little bit more than half after your first round is pretty much in a typical ballpark. So that's probably in the ballpark of what would happen. So I think we've gone just about at our end here. I do want to leave time for a couple of questions here on anything that was gone over. I did go through a lot of material, and you'll have these files.
Where do we find the files?
What's it?
Where do we find the files? Or archives?
Yeah.
On the Connect site under archives is where you find files. Is it by Connect's class?
Yeah.
Okay.
Yeah, the table.
So you go on under archives and then pick your class and the associated files.
Thank you.
Any other questions? Okay, well, I thank everyone. And I know that was a lot of information. I talked fast, and I appreciate it.
Thank you.
Okay, thanks.